Hey, good morning, guys. Welcome to Market Mondays. Hopefully, you guys had a great weekend. I'm going to give you guys an update on everything that happened last week just because there was so much information that came out that really impacted the markets. Before I get right into it, I'm going to do a quick dad joke. Dad joke today is I got mugged by six dwarves last night. Not happy. Get it? Pew pew. All right, so getting right into it. Last week we got jobs report, we get the last inflation report for the month, and it was really hard for the market to really decide which way to go. Also, we got a lot of manufacturing data in regards to how the economy is doing. So all these things point to, our potential pending doom of a recession or recession-like activity. Now, keep in mind, having recession-like activities, what it does for mortgage rates typically is that the mortgage rates generally get better. So from what we're seeing moving forward is that if all these recession signs come to fruition on these economic reports, we might start seeing mortgage rates come down. So the first report that I want to kind of share with you guys is the unemployment report. So what came of the unemployment report was that it was flat for the most part. It stayed at 4.2. It didn't come down. It didn't go up. But one of the things that is a very obvious thing that we need to share is that the unemployment rate on how they share the information is based on a rounding number. So if it's 4.15, they're always going to say 4.2. So sometimes it's not a true 4.2 or 4.1. It might be slightly another decimal point to the right, depending on how you're looking at the numbers. So if it's 4.15, they're going to round that up to 4.2. If it's 4.14, then it's going to be rounded down to 4.1. So for the most part, that change, that small incremental change, could be a difference of 0.1% for that next report. So to give you a bit perspective, when we got the unemployment rate for March, it was actually 4.15. Now that we get the actual report, it's actually a lot closer to 4.2, more of a true 4.2, like 4.19. So that's something to really keep an eye on, is that the unemployment rate is technically going up. It's just very incremental, and due to how rounding works and how they're using it, they're not really showing those numbers. But that's a really big important piece, is that the unemployment rate is at a small level going up. But if you're looking at this chart, it's really just flat. So what does this do? It's showing further weakness in the market with all the layoffs and unemployments that are happening. Keep in mind, some of these people may have not filed for unemployment. Some of them may continue to file for unemployment. There might be times where our seasonal change where there's a bunch of jobs all of a sudden and these get filled. So sometimes the numbers can get skewed inside the report. But overall, what we're seeing is that the unemployment rate is still remaining above 4.0. Keep in mind, the Fed didn't think about last December, they didn't think the unemployment rate was going to go past 4.2. So we're getting up there with the numbers. So this is one of the pivotal reports in regards to how and determining how mortgage rates are going to trend on this when this report comes out. So just to give you guys an idea, this report came out last Friday, right? And it came out that morning. Mortgage rates responded immediately because all the investors moving their money around as soon as this unemployment rate came out. Now, another report that we want to share is the home price index. So a lot of people are concerned on how the home price index is going to be impacted with how mortgage rates have been, how the home prices have been. There's not enough homes to buy in the market. Well, the tough thing is that what's first? What's more important? Is there not enough buyers, or is there not enough homes? Well, the thing is, if there's a lack of transactions, the problem with what's going on right now is that in order for your transaction to go up, is that you have to have buyers and you have to have inventory in order to show the amount of transactions that are happening. Well, one of the toughest things is that home transactions are down because there's not enough inventory. Now, this could be attributed to mortgage rates being higher. A lot of people don't want to buy a new house with higher mortgage rates. Now, so that is neither supply or demand. That's just bringing the overall supply down, kind of the level playing field in a way. But in this case, we thought a lot of people had felt that the home price index or appreciation index, home price appreciation, whatever you want to call it, it's still showing positive numbers. And to give you guys a bit of perspective here is that 3 to 5% is pretty on average since 1940, I think, since the 1920s. So appreciation between 3 to 5% is what we need to be in. The home appreciation we saw between 2019 and 2022, extremely unsustainable. We're seeing an average of 10% a year. Just to give you an idea, 10% is a lot. If you think about it, a $550,000 house, that next year is worth $550. A $50,000 change in purchasing power every single year, it does make home prices way less affordable than what we see now with 3 to 5%. So it's nice to see home appreciation back in its normals levels. I do like seeing that a lot. So that makes us feel a lot better with how things are trending when it comes to being able to with home affordability. The other thing that came out last week was what's called PCE. So this is how the Fed is going to measure what the inflation. This is their main focus in determining how they're going to adjust the Fed funds rate or the Fed rate. So what their plan is they want to see this PCE inflation report to come down to closer to 2%. Now, this is the inflation reports that come out. Again, there's 3 of them. The inflation that's come out are another pivotal thing in regards to how mortgage rates trend as well. So the 2 major things are inflation reports and unemployment report. What's nice about this specific inflation report that it shows that it's coming down, which is a good sign. We're seeing inflation getting to a more sustainable level than what it was almost 18 months ago, really 12 months ago, if you really think about it. And we were seeing, or even I guess we should say 2023. 2023, again, we were seeing almost levels of like 7 to 10% across all those 3 inflation reports. So now we're seeing numbers coming down quite a bit. And what's tough is that as it gets closer and closer to this 2% number, it's going to get harder and harder to reach that 2% number. We saw a drastic change, and then now it's kind of leveling off. It's plateauing effectively, is how the best way to describe it. So it's going to take a while, I think, for it to get to the 2% level, faster than it went from the high above 6 to down to 3. I think it's going to take a lot longer to get down, which is true. It's almost taking 12 months to go from 3.0 to 2.6. It even reached 2.5 at some point. But that's what's kind of interesting to see, that in the last 12 months, it took that long to get it down to 0.5%, when in about 12 months we saw it go from 7 to 3. So something to consider. But I think the main thing that's going to cause the Fed to decide if they're going to lower the Fed funds rate is probably if the unemployment rate reaches 4.3. I think that's the main thing. This is going to take forever to get down to 2%, probably another 12 months potentially, if is the rate that we're seeing. Now, how's this impacted rates overall? It's kind of tough to say. Like, it was all over the place for the entire week because so many reports came out throughout the entire week on different days. The main thing that caused mortgage rates to go up in the last couple of days, really within the last 5 business days, is that there's been reports of the manufacturing data showing that improvements of manufacturing information. So one of the things that we want to share with you guys is that it's going to be very volatile over the next couple of months. Kind of give you guys an idea of what rates look like right now. Let me share that screen right now for you guys. So this is what mortgage rates have been kind of trending in this direction. It's pretty much the entire week it went down a little bit, and then at the last day it went up and kind of plateaued over the last 2 business days. What's to happen? We don't know. There's been conflicting reports around the labor market information. So the unemployment rate is one aspect of it, but there's something else called the BLS job reports, continuing claims. All these reports can be a bit conflicting to each other currently, showing that these numbers are better than they actually are. I think one of the things that is a concern is that the BLS job report is not showing the most accurate data. They think that after the revisions, it's going to bring these numbers down. So we'll see. But overall, this is kind of what's expected to happen, is that we are expecting to go into further and further into recession. therefore causing mortgage rates to come down. When that's going to happen is really based on the economy. They already have one negative quarter of GDP for quarter one, so we'll see how quarter two comes. But that's kind of a really big factor in regards to what's happened next. That's about all I got for you guys today. It's a big week, but I think we're trending in the right direction. And knowing that a lot of people see a recession now, that's going to be more evident as we go further into the year. Otherwise, that's really all I got for you guys today. Hopefully you guys had a great week. Have a great week. Otherwise, nuke out.